Okay, and welcome to the first video of Chapter 7. We're going to be talking a lot about contribution margin and how to use it for our decision-making process. This middle section of the 3 sections of the course, the Exam 2 material, is focused on short-term decision-making. In Chapter 6, we started looking at cost behavior, and now we're going to use cost behavior to start building a model that allows us to make some decisions. Just remember, this contribution margin is not the same as gross profit and what you learned in the Intro to Financial. This is a managerial way of looking thing, or a variable cost way of looking at things. So let's go ahead and take a look. We're going to cover the first 2 learning objectives tonight. We're going to cover learning objective 1, 2 ways to calculate this contribution margin, and then look at the first basic decision making. First basic decision making is how many units or what's my total revenue that I need to do to break even or to make a certain amount of profit. So I'm going to use an example that I have used many times before. Let me take off this. There we go. And if you don't recognize what this is, it is like a K-cup machine. You know, one of those little coffee makers where you have the little cup that you put in and it makes a cup of coffee. So I'm using this because I really want to get down to some basics of, let's see. We're going to be looking at just 2 really basic components of this. We're going to look at a fixed cost and we're going to look at a variable cost. Remember, that's kind of the things we've been looking at all along. So let's say, for example, that you are selling coffee outside of a local grocery store. The local grocery store allows you to do this, and someone is getting you in this business. There's some individual. He says, I will loan you the coffee cup machine for $10 a day. So that's your fixed cost. It doesn't matter how many cups of coffee you sell. You have to pay. That's like the rent, right? It's the fixed cost. And the fixed cost is defined as those things that are not affected. The costs are not affected by the amount of production, by the amount of units sold. Now, the variable cost, when we go down here, this guy is going to say, hey, look, you don't have to pay for K-cups in advance. You don't have to buy inventory, so we're not going to worry about inventory. In fact, he's just going to say, whenever you want to buy a K-cup is going to be $2. Every time you need to make a cup of coffee, put in $2, take out a K-cup. So this down here, this is going to represent these 2 blocks. These are all dollar blocks. So if you notice, we've got a total 10 blocks here. This is going to be our fixed costs. Now, we're going to sell this cup of coffee to people coming by. We're going to sell this. This is going to be the sales price. And the sales price is going to be $3. So you can see that $2 of this right away is my variable cost. In other words, to make the cup of coffee to sell to the individual, they give me $3. I'm going to immediately peel off 2 of those dollars and buy the actual variable cost, the thing that I need to make the unit. In other words, I only have to spend this every time I make another unit. So every time I make a unit, I spend $2. Well, what's left over? What is this magical green block? This is the contribution margin. And we call it contribution margin because it's not profit, or at least it's initially not profit. And why is it not profit? Well, remember, we still have this fixed cost, right? So let's say we just sell 1 cup of coffee, right? 1 cup of coffee. Well, we spent $2 on the K-cup, right? That's the variable cost. And then we have $1 of contribution margin. In other words, that would have been just the first block here. We would have just said, we have contributed towards paying off our fixed cost. We've only contributed $1. So without trying to figure out a big calculation, how many cups of coffee, just think about it in your head, how many cups of coffee would I need to sell to pay off the rental of the K-cup machine every day? Well, it's pretty obvious. I'd have to sell 10 of these cups of coffee, right? When I sell 10 cups of coffee, well, I'm going to end up spending $20 on the bunch of K-cups, and I'm going to have $10 left over, and that's going to cover all of this. So that is kind of the first step to realize is the contribution margin first contributes towards the fixed cost. Now on cup number 11, let's look at cup number 11. Cup number 11, I still have to pay $2 in variable costs, but now I've got an extra dollar that, well, what is it going to? Well, I've paid off the fixed cost. This is your first dollar of profit. And that's why this is an important sort of calculation to figure out, this variable cost. So we will look at a couple of different ways of calculating this, but just realize we want to, the first set of answers in our business is how many units do I need to sell to break even? Well, here, 10 units. Well, at 10 units, if I'm selling this for $3 a unit, that we could either say it's 10 cups of coffee or $30 in sales represents break even. So that is when you're looking at the other problems and they're using bigger numbers and maybe kind of throwing things in a different order, maybe come back to this beginning part and run it again, just so you understand the interaction between the individual unit contribution, right? This is the contribution for just one cup of coffee, and the fixed cost, and where's the break even. Okay, so let's go ahead and take a look at question number 1. So this particular little scenario, they've got a bunch of text on the question. It's something about guests dining and dinner tickets or a dinner cruise, but we're just going to pull out the relevant information. So the sales price, this is the sales price, right, is $50. This is the variable cost, and this is the fixed cost, right? So looking back up here, that's the only things that we really needed to know was we needed to know the variable cost, the fixed cost, and the sales price, and we could figure out the contribution margin and a whole bunch of other things. So the first thing is, well, what's the, and I'll put it in red here because there's actually 2 formulas that we're interested in. We're either looking at it as a unit contribution margin or we're looking at it as a ratio. So this is going to be in dollars and this is going to be in a percent. So we look at the price per guest, $50, minus the variable cost per guest, $30. So the contribution margin per guest is $20. That's like saying our cup of coffee is $3, our K-cup is $2, and our contribution margin was $1. So same straightforward formula. What is the ratio? Well, just to kind of compare it with up here, if I wanted to know what was the contribution margin ratio, well, if the contribution margin is 1 and the sales price is 3, what we're saying is 1 out of every $3 is contribution margin, or 33%. And that's kind of what we're looking at down here. What is the contribution margin per guest? Well, we just figured that out. That's $20. The price per guest, $50. And the ratio here is going to be 40%. So these are the 2 kind of basic formulas, either the actual dollar amount of contribution margin or the percentage. When we go down here and we want to figure out a little bit further, so here we're going to guess. Okay, they had a certain amount of guests, but they're saying figure out, using these numbers, figure out what would the income be if there were 17,000 guests. Well, we say, okay, there's 17,000 guests. Contribution margin is 20, which we figured out right up above. So the total contribution margin is 340,000, right? The same thing that we figured out here is this. I said, if I had 10 cups of coffee and the contribution margin was $1 per cup, 10 times 1 is 10. Well, that just covered our fixed costs, right? And that's essentially what we're trying to figure out here. We're saying, okay, if we got a total of 340,000, did that cover our fixed costs? Well, what were our fixed costs here? Fixed costs were 210, right up here, 210. So that we would say that we made enough margin to not only cover our fixed costs, but what was left over is going to be the profit, or here in this case we're going to be calling it operating income. Okay, so the next thing they want us to do is kind of do something similar, but with the ratio. So if you notice here, I've kind of indicated when you're looking for a dollar amount, well, I'm not going to go that far. Sometimes you can tell by the type of answer they're looking for which one you should use. But let's just take a look at, they give you units here. And so that's kind of the important thing here. And here they give you dollars. So the number of units corresponds to which one you should use. And this one, the dollars, is better for the ratio. So project the operating income if the revenue totals $595,000. Okay, so here's the $595,000, right? So what is the CM ratio? Well, we figured it out up here. The contribution margin ratio is 40,000. So out of that, well, let's see, 40, well, I'm using the eraser a bunch tonight. And to be honest, I don't know if I'm getting any better at writing with this, maybe a little better. 40,000. No, shoot. The ratio is 40%. That was like saying up here, our contribution margin was 33%. 1 out of every 3 sales dollars was contribution margin. What we're saying here is 2 out of 5, or 40% of the revenue dollars is contribution margin. So that comes out to 238. Now, does 238, once again, we're going to see, does it cover our fixed costs? 238 does cover our fixed costs. The fixed costs are still, it's 210. And our operating income is a little bit lower, but we're still making a profit. So you can see we're looking at 2 different ways. Your boss could come in and say, I'm thinking we're going to get this many guests, or we're going to sell this many units, and you could figure out what's the operating income. Or they could say, I'm projecting, like the sales department would say, we're projecting X amount of sales. What's going to be our operating income? And you could still figure it out. So let's move on to question number 2. So this is a short one, and it's very similar to what we have. In fact, I've pulled down the previous calculation. So it's still the same scenario. Tickets sell for $50 for guests, the variable costs and the fixed costs. So what they're saying is, on the margin, if we sell an extra 700 tickets. Now, I'm pointing out something a little basic here to this question is, well, we did the previous question, and so we know that they are making a profit. But here, the operating income increase or decrease, in this scenario, we may not actually know, because if we didn't know that they were actually making income, in other words, we may not have even known they had broken even. So just FYI, this question is a little dependent upon the first question. Just asking this question in a vacuum, did operating income decrease or increase? We wouldn't necessarily know until we actually would have figured out whether they had broken even or not. But anyway, in the first part, question number 1, we figured out there was a $20 contribution margin per unit per guest. And so we're saying, okay, well, what happens if we get another 700 guests? So very simple. We already have the contribution margin from when we pulled it down, from when we figured it out before. Now, obviously, if you have a different set of numbers in your question, and it's very likely that it will be that, is you will have to go through this little process again, figure out the contribution margin before you plug it in. So here the total contribution margin would be 14,000. That would be the extra amount. Okay, so for the last question for learning objective number 1, in other words, we're just trying to get a sense of contribution margin and the 2 formulas, the unit contribution margin formula and the contribution margin ratio formula. Yes, we end up saying contribution margin a lot in these chapters. Okay, so notice here we're given a little bit of information. Now notice this is not an income, it's not a normal income statement, it is a contribution margin income statement. And because we see one of the middle things here is we figure out contribution margin. And remember from the last set of homework, contribution margin income statement deals with variable costs first and then fixed costs later. And in between, rather than having gross profit, we have contribution margin. So it says prepare, and I think in your homework it actually gives you two different levels. I'm just going to prepare one of them. It's the same process for both. I think one comes up to you're not breaking even, you're losing money, and one comes up to you're making money. So just FYI, you'll have to do this process probably twice in the homework question. So what are our variable expenses? So it says prepare the contribution margin income for sales level of 230. Well, we can go ahead and plug that in right here. 230,000. Now we need to figure out the variable expenses, and then that calculates to the contribution margin. And then, well, actually, I think we're given the fixed expenses up here, right? So 172,200. So we need to calculate this. This is just a subtraction, and then this is another subtraction. So really, we just have to figure out this number first. So we would start up here and go variable expenses divided by sales. And that's going to give us a rate, 40%. Now notice I'm not calling this the contribution margin rate because it's not. And we'll see a little bit later why it's not. But just be aware, this is the variable expense rate. This is 200 and what part of the total revenue, what part of this is this? Well, we're saying that the expenses, the variable expenses is 40% of it. So we would say, okay, let's take this new sales number, 230,000, times this rate to figure out what is our new expenses. And actually, I see a typographical error. This should not be operating income. This should be the new variable expenses. Because this is going right down in here. So this figures out to be 92,000. So we would say the new variable expenses are 92,000. The new contribution margin is 138. Well, you can see we didn't sell enough. 138 minus our fixed expenses. It's as if we only sold 6 cups of coffee. We needed to sell 10 to pay for the rental, but we only sold 6, so we didn't actually make enough money to cover the rental. So that's this problem right here. So this ends up being minus 34,200. And like I said, I think the next version has a higher sales level and that you're actually in the positive. So just FYI, I see here that I'll try and correct that when I post the actual document. So that should be variable. It should be this, the variable expenses. Okay. Now here, we're actually going to talk a little bit about what I was just mentioning. What were the different percentages? Now, you notice I've bolded out here a little bit and I've grayed out that same bit of information. So what we said was, okay, if sales revenue represents 100%, and sales revenue is made up of two things. So I'm going to quickly slide back up here. What we're saying here is that, once again, we said sales is represented by two things. If this is the sales amount of the cup, and so here we're just looking at the unit, but you can think of this as the total sales as well. So some part of it's going to be variable costs and some part of it's going to be contribution margin. That's the two parts that go into sales, whether the unit or the total. That's what sales is made up of. So when we come back down here, that's why I've grayed out this fixed expense thing. I'm just looking at if sales is the 100% and variable expenses, and we already figured out that variable expenses was 40%. Well, what must be the contribution margin? It must be the rest of it. So by default, the contribution margin is 60%. In other words, sales revenue is, when we're looking at those 3 bars, the bars for the coffee cup, if the total bar is 100%, well, and if the variable expenses is, in this case, the variable expenses was 40%, so I know this is not to scale, well, the rest of it has to be the contribution margin. So we're really, it's a little bit, I don't want to say tricky, but unless you're paying attention to the names of it, it may not seem like, where did they get that number? Well, all we're doing is making sure that we understood sales is made up of two things: variable expenses, the variable costs, and the contribution margin, and those two percentages should equal 100%. So when I come up with this and I say, okay, the question is compute the break-even sales in dollars. So here's the next thing that we're introducing, the little equation. So we are going to pull in the fixed expenses now, because this is our break-even equation. But we can also use this for if we wanted to calculate how much would we have to sell if we wanted to get a certain amount of profit. Well, break even by default means we're not losing money and we're not gaining money. So we're going to use the same equation later on, but right now for break even, income is zero, because that's what break even means. It means not losing any money, but also not earning any money. And so to get that, we would divide by the ratio, and the break even sales is 287 something, 287, or just 287 even. And what does that mean? It's as if we're saying, okay, we've got a total sales bar here. We've got a total sales bar here, and we're saying that 60% of this bar is the contribution margin, right? And we're saying the contribution margin is this 172 number. So we're saying, okay, if 60% of whatever this total bar is represented by 172, what's the total bar? And for those of you who don't see the, I guess, relationship of some of these mathematical things, is that all we're doing when we're dividing by 60% is we're saying 172,200 is 60% of what larger number? That's why we divide by 60%. 172 is 60% of what larger number? So in other words, if we multiplied 287 times 60%, we would come up with 172. So anyway, that's how we use the contribution margin ratio. And that leads us nicely into the second learning objective, which is break even and target profit. And just FYI, I know that Chapter 7 has a few more questions. They're relatively simple, straightforward, but there's enough of them that I want to explain them. So this and probably all the Chapter 7 videos are going to be a little longer than normal. But I think kind of repeating the information will get you there. Okay, so here we're going to kind of redo a few things. So if you notice, we still have this same scenario. Sales price is $50, variable cost is $30, and fixed even is $20. So rather than recalculate this, you may have to recalculate it in yours, but remember, first thing you need to do is calculate the contribution margin. And it says calculate the break-even units. In other words, how many guests do we need to have? And what would be the sales? So we can do that two different ways. When we're looking at the units, we're going to be using the unit contribution margin. Now, you can actually use both of them. You just need to know how to, but this is probably the most straightforward way. So we're going to, this is the equation. So fixed expense plus whatever profit you want divided by the unit contribution margin equals the break-even units. And let me give you an example with our coffee cup. We said in the coffee cup that we had $2 of variable costs and we had $1 of contribution margin, right? And we said our fixed costs were $10. And we figured out, well, I needed to sell 10 cups of coffee, right, to break even, because every cup of coffee gave me $1 free to contribute. Well, what does that mean? Well, that's fixed costs divided by the unit contribution margin equals break even. Well, that's all that we're doing up here. Now, we were able to do it intuitively without knowing a formula with the coffee cups just because it seemed pretty straightforward and we could actually count 10 cups of coffee. But there's actually a formula that you figured in your head that you didn't realize. So if I said the contribution margin for each cup of coffee, let's say I was selling it for $4. Let's say I had another dollar on there and that the contribution margin was $2. Well, you could see, well, I could reach break even in half the time, 5 cups of coffee. And that's all we're doing here. So we're taking the fixed expense, and this time it's going to be 210. And here we're working on break even, so we're going to be 0. So obviously the first time we say how much profit, well, remember the contribution margin first has to go towards the fixed expense. The nib's a little worn down. And then we can start working on profit. So the contribution margin, we figured that out from here. This is 20. So when we calculate this out, we're saying 10,500 units to break even. Now, if we wanted to say, well, what's that in sales? Well, I could take that number and multiply it by $50, right? That would give me the sales. Or I could use the contribution margin ratio, which is the fixed expense plus the operating income. Still we're working on break even, so it's 0, and the 40%. And remember, we're saying the fixed expense of 210,000 is 40% of what larger number? Well, in this case, it's 525. Now remember, if we had multiplied this by 50, we would get the same number. It would just be one more step. Okay, let's take a look at question 5. So this is another short one, but looking at it in a slightly different way. This one is, we're not now asking break even. We're saying, not only do I want to break even, I want to cover my fixed costs, and I want to earn 30,000. So once again, now this is the calculation we have from before because it's the same scenario, but yours might be different from each question. So we'd figure out the contribution margin per guest, and we would do the same thing. The only difference is we need to sell enough tickets to cover our fixed expenses, plus an additional set of tickets to cover our desired income, our desired profit. So we would add those two together and then divide by 20. Oops, just divide by 20. And to earn 30,000, we'd have to have 12,000 units, and then we'd multiply that to figure out how many dollars if we wanted to do that. Calculate the total operating income. So this would be how many units, and then we'd multiply that by 50 to get. So that would be 600,000. So depending on what they're asking, so I'm not really sure how many tickets must be sold. Oh, they're just asking how many units. So they're asking how many units. So it's not dollars. It's just the units, so 12,000 units. If they were asking dollars, you could use this one to get the dollars, or you could use the other ratio. Okay. Ooh, I don't know how that happens so far in the document. That happens several times. I don't know if it's as I'm dragging up, because I check it at the beginning. Okay. This last bit, so if you notice over here on the, what is it, right above, oop, you can see my hand disappear. Above here, I'm not going to demonstrate question number 7 because it entails a lot of what we just covered, just asking it in a slightly different way. But there is one thing here, and on question 6, which is a graphical representation of these things. Now, we got into this when we first started graphing the costs, and so we're going to build upon that. So I'm just going to do this kind of as a reminder. So if you remember, this is going to be dollars, and this is going to be number of units. So if you remember, we had a line here that represented fixed cost. Remember, fixed costs didn't change no matter how many you sold. In other words, that was rent or whatever else. Then for every unit that you sold, you had additional cost. When we were talking about bikes, we said, for every additional bike we sell, we're going to buy some tires or wheels or whatever. So that is kind of the graph that we had before, and we called this the mixed costs. Well, when we start looking at it from, in fact, let me make this a little bit lower slope so it can all fit on there. Let me just make that a little bit. So when we start with revenue, so we're going to add one additional line. If you sell 0 items, well, you have 0 revenue. So for every item that you sell, you're going to have an additional amount of revenue. So hopefully your revenue line is steeper than your cost line. In other words, you're selling it for more than your cost. Well, as you can see, this is kind of representing our variable cost situation, where now remember this line here is built on top of the fixed cost. So this, whatever the number is on this line, along this line here, this represents both the fixed cost plus the variable cost total. So this is both of them. At this point, well, what is this point? This point is where your total cost, fixed and variable cost, is equal to how much you bring in revenue. So this is actually our break-even point. And so this would be the break-even units, and this would be the break-even dollars. Now in this area right down here, this is where you're losing money, where you're gaining some revenue, but they're not covering your costs. In this region here, this is your profit, because you still have all of these costs, but your revenue is more than your profit. So that is kind of the basics. It's all we're doing is to the previous fixed cost and variable cost line, we're adding a revenue line, and we're looking at where they intersect. Okay, so that was a little bit longer than the previous ones, and like I say, chapter 7 is probably going to have a little bit more, a little longer videos. But if you have any questions, please email me, and hopefully the homework is doing well. Thank you, and have a good night.